Hello, Leonard. How are you today? I welcome you to another economics class. Today, we'll be looking at a topic called financial institution, and I would like you to pay attention. Now, when we talk about financial finance, what comes to mind is money. And then when we talk about institution, what comes to mind is a system. So, indirectly, what are we talking about? We're talking about money system, a system in every country of the world that allows money to flow from those who don't need them to those who need them. So, financial system or financial institution is an institution that houses a lot of firms in the financial sector, allowing them to interact with them among themselves. Not only that, to also interact with potential customers. Now, I believe you've seen some of these financial institutions, and all that they have in common is money. They all have money in common. First Bank down to the Apex Bank in Nigeria, or say the highest bank in Nigeria, which is the Central Bank of Nigeria. We have a Wema Bank, and we have a GTB Bank. All these are popular banks in Nigeria, and they all deal with money. So, what are financial institutions? What are financial institutions? Now, financial institutions are organizations which deal mainly or primarily in money. So their job is very simple. They help to pool money together through savings. They help to pool excess liquidity from millions of individuals and firms within the country. They pull them together and then make this money available to those who need them or where there is less liquidity. So their job is very simple. They mop out excess liquidity from individuals and give it to those who need them for business. So they are like middlemen. The financial institutions are like middlemen. They take money from where it is surplus and move it to where there is deficit. Take note of that. So, irrespective of the financial institution, you can remember your banks, your Zenith banks, uh, Stanley Bank, your uh, Polaris Bank, and name them in Nigeria or any other bank in your country. Their job is very simple to move out money from where it is surplus and then bring it to where there is deficit. So they pool resources together, they pool money together through savings and give it to those who need them for investment purpose. So it offers financial services such as investment loans and deposits. That's what they do. Okay. So your financial institutions and their customers operate in a market called financial market. Remember, we have different forms of market in economics. We have the capital market, as you can see. We have the money market. We have the factor market. We have the labor market. Under the factor market, we have the labor market. We have the land market. So we have a lot of markets. We have the commodity markets in a lot of markets in economics. But your financial market is your financial institution operate in a market called financial market. Now, under your financial market, we have two main markets there. We have the money market and the capital market. So under the financial market, we have two main markets there. We have the money market and the capital market. So as you can see, all these institutions you can see from your banks down to your insurance, down to your discount houses, down to your pension fund administrator, down to fund custodian and stock brokerage houses, mortgage financial houses. All these are operators in your financial institutions. So they operate in the financial market. Now, depending on the kind of job they do and the kind of services they render, will not classify them into either money market or capital market. But as we go on, you will be able to classify them either they operate in money market or capital market. You will. I'll be telling you some of the things you look for to know that, oh, because this company um, perform this duty, because they provide these services, then automatically they operate in this market. So let's move on. Let's look at money market first. Now, what is money market? Money market is a financial market for the borrowing and lending of short-term loans. So take care of that. Take care of that. That is a key word there. Money market operates in a financial market mainly to provide short-term loans to individuals that need them. It is a market where financial instruments with a short-term repayment or redemption period of less than a year are bought and sold. So we can say money market is a market where money or loans are acquired. Money or loans are acquired on a short-term base. So it's a market that allows, just like any other market, that allows buyers and sellers to meet. So money market is a market that allows buyers and sellers of loans to meet and then negotiate terms of conditions of getting the loan and terms of payment of the loan. So money market is under the Apex Bank, which is the central bank. So the central bank controls the activities of these markets. So central bank is the apex regulator of the money market. So it controls the activities of the buyers and the sellers in this market. Take note, what are they buying and selling? Loans on a short-term base, usually less than a year. So we have the operators under your money market. All these are the banks you know, most especially the commercial banks. The commercial banks and your microfinance banks are under your money market because they deal mainly in providing short-term loans to investors that need them. So all your commercial banks are under the money market. Remember, we have other banks. We have the development banks. We have the merchant banks. We have the mortgage banks. Okay, but your commercial banks are under the money market. They are the major operators under the money market. So what are their functions? What are the functions of the operators in this market? What do they do? So let's look at the function of the money market. One, they enable investors to meet. Okay, enable investors to meet with potential lenders of money. So enable investors meet short-term investment need. It's a market where investors will come and meet those who can borrow them money and they talk on terms and conditions of such loan. So it's a market that allows investors to come in. Two, it enables individuals and firms to meet temporary cash and financial need. So it's a market where you as an individual can run to get money on a short-term base. You are short of money, you need money to pay your house rent, you need money to meet up the bills at home. Okay, you go to this market and you can get money. Some of your parents operate in this market. They get quick cash. We have a lot of them around us. Okay, quick cash where you'll be able to borrow money within the space of a day, 2 days, and then they give you the money and the condition of service or servicing the loan are agreed on. Three is a market which help to promote economic growth and development. Why? Because it provides capital for investment. So this market is very important because in this market, capital is provided for both small and medium scale businesses to operate. So it promotes economic growth because money is important. Money or your banking is one of the aids to trade. And once your banks are strong, definitely money will be provided for investors who need to invest in providing goods and services to people who need them. So if your money market is strong, then it shows that capital will be made available to investors who need them. Not only that, it provides government with the means of raising revenue. Yes, government can raise revenue from this money market through tax provided by the operators in this money market. Government get tax from banks. How do you know that? From the profit made from this bank, government can get revenue from them. Government is really making a lot of money through CBN from these banks. Not only that, The operators in the money market, which are your banks, provide other services apart from money. They help you to keep your money and other valuables. Okay? Remember that at home, you might not be comfortable in keeping such things at home. It might be your will, it might be your jewelries, it might be something important to you that you don't want other people to know about. Then your money markets or your banks can help you to keep such valuables until you need them. Six is one of the major or the primary function of this bank to provide short-term loans. Okay, so it allows borrowers and lenders to meet. Money market is very helpful in implementing the fiscal and monetary policy of the government. Yes. When we talk about fiscal policy of the government, we're talking about two variables there. We are talking about government expenditure and tax. Government expenditure and tax. And when we talk about the monetary policy of the government, we are talking about money demand and money supply. So these four variables I've mentioned are very important in helping the government to control and stabilize the economy. Whether there's inflation or there's deflation, it helps the government to be able to control the flow of money, the circular flow of money in the economy. So let me expatiate a little. So when we talk about fiscal policy, I told you that there are two instruments there. We have the tax as an instrument and government expenditure as another instrument. So if there's inflation, what government will do is to increase tax. When they increase tax, they reduce the amount of money in circulation. They reduce the amount of money in your hand to buy things. So indirectly, they reduce your purchasing power. So if that happens, it reduces the amount of money in circulation. Take note, when there's inflation, government will try to mop out money from your hands, from the circular flow of income. And how do they do that? By increasing tax, the tax you pay, direct tax you pay, the indirect tax, they increase it to mop out money from circulation. And of course, government expenditure will reduce. Remember, government also purchase items. They give contract out on projects. All this will be reduced to reduce the money in circulation. But if there is deflation, there's less money in circulation, government will just reduce tax to allow more money in your hands to buy goods and services, and they will not increase their own expenditure. Government expenditure will be increased to make more money available, okay, through contract, awarding of contract, payment of salaries to teachers, increment in salaries of civil servants, all this pumping more money into the economy. Now, for monetary policy, this is one of the instruments used by government and central bank. Their job is to do that. So when there's inflation or when there's inflation, there are a lot of tools that are used, starting from your open market operation. Okay, a lot of tools there, your treasury bills and treasury certificate, all these are being used to make sure that the circular flow of money in circulation is reduced. It's reduced. So when there's too much money in circulation, government will just try to increase interest rate. Interest rate is one of the tools. They just increase interest rate. Once they increase interest rate, it discourages borrowing. Those that want to borrow money will be discouraged because of the high interest rate, and then that reduces the money circulation. And if there's a deflation, there's less money circulation, or there's recession, or there's depression in the economy, government will try to pump in more money into the economy, and they'll do that by reducing interest rate. Once they reduce interest rate, you can go to the bank and borrow more money at a lesser rate. So as I've said, central bank is the apex bank in Nigeria. So every central bank you see in any country of the world, that is the apex bank, the banker's bank, the highest financial institution in that country. It's control and organize the activities of the other operators in that financial market. So, who are the operators in this money market? The operators in the money market. We have the commercial banks, as I've said, that they are one of the operators. So, all commercial banks, be it Zenith Bank, be it Wema Bank, be it GTB, Polaris Bank, they are all under commercial banks. So, they accept deposits and grant short term loans. They help the public to keep their valuables and they are there to make profit. They are there to make profit. And how do they make this profit? By charging fee, by charging fee uh, on whatever service they are rendering to you as a middleman. Okay, remember that sometimes when you want to pay your DSTV bill, you want to buy your recharge card, you want to pay your school fees, you use the services of this bank. So they charge fee or commission on those items. And another way they get money is through interest rate on loans given out. So we can call them retail banks. Retail banks. Why? Because they are nearer to the final consumer. They're nearer to the final consumer. So one of the operators in a commercial bank is in the money market easy or commercial banks. The second operator in the money market is the central bank. The central bank is charged with the responsibility of keeping a country financial system under close supervision and control. And that is why you see, if any of your commercial banks are not meeting up with their expectations, you can report them to CBN. Yes, you can report them to CBN, Ministry Central Bank of Nigeria. They can be reported and they will be sanctioned. Sanctioned. Why? Because their activities are controlled by the central bank. So you go into the bank if you make some deposit or you made some transfer and your money hanged, meaning the person you made the transfer to did not get the money and the money has left your account. There are rules and regulations guiding the activity. So within the law says within 3 days, working days to 5 working days, the money should return back. But if after waiting for those days and your money is not reversed back, you can report them through any of the social media handles, through your Twitter, your Facebook. You can report them to central bank and action will be taken. And some of these banks don't want you when you mention central bank to them that you want to report them to central bank, they will be begging you to please don't. Why? Because they know that central bank is the apex bank. It controls their activities. Now, in every nation of the world, they have a name they call the body or the bank that control the activities of the other banks. Majority call them Central Bank of Nigeria, Central Bank of Ghana, and name it. But in US, America, it's called Federal Reserve Bank. So in some cases, when you hear Federal Reserve Bank or Central Bank, is we are referring to the Apex Bank. So this bank operates both in the money market and the capital market. They operate both in the money market and in the capital market. So let's look at more operators. We have the discount houses. The discount houses. Now another name for discount houses is called bill broker. Bill broker. They are also one of the major operators in the financial market. Their job is very simple. They act as an intermediary between the lender and the borrower, especially uh, when it comes to treasury bills, when it comes to instruments and securities. Yeah, you see more of them. So what they do is this: they buy and sell treasury bills. They buy and sell treasury certificates. Their function is much. So take note, they serve as an intermediary, as I've said, in the money market transaction. So when you want to involve in short-term investment, when you want to go into short-term security trading, you can use them. You can use them. So they also help in trading in securities and in instruments, talking about treasury bills, treasury certificates, commercial bills, commercial paper. You see them there. They don't only operate in the money market, but you also see them in some other markets. For example, under the money market now we have the primary market and the secondary market under the money market. So you see them operating in bonds, the auction bonds in both the primary market and the secondary market under the money market. Sometimes they can serve as a manager of a liquiding assets. They also serve as a asset manager as well. So their job is enormous. So and how do they get their money? They get their money through commission. Through commission. So a good example is this: they negotiate and purchase of various certificates of deposits, commercial paper, and other money market instruments, just like your treasury bills, treasury certificates, or other money market instruments, before their maturity dates at a rate below the full value. So before the maturity date, they come to you and obtain, they take over such instrument from you and pay you at below the face value, and that's how they make their money. That's how they make their commission. So another operator is the acceptance houses. So when you hear of acceptance houses, majorly they are involved in international trade. They are involved in international trade. They make funds available to um, investors or to citizens who want to involve in international trade. So what they do, they serve as guarantor to provide support for bills used in settling debt in international trade, which other financial institution, with other financial institution, whether local or foreign, they accept it. Why? Because they sign as a guarantor on such bills, on the face value of such bill, they sign as a guarantor and charge commission on such services. So if you are someone that is involved in international trade, you need the services of acceptance houses, okay, to sign or support any form of bill you are trying to pay. They help even in settlement of such bills, and they charge you commission on them. So we have that's one example of your discount house. So instruments used in the money market. What are the instruments used in the money market? Number one, we have the bill of exchange. The bill of exchange, I believe you've had that before, is just like your check or your bank draft. That's how it looks like as well. So is a written unconditional order to a person requiring them to make a specific payment to another person. So just like your checkbook operates. Remember, your checkbook is moved from the first party to the second party to the third party. Okay, so also your bill of exchange operates. So it is being signed, okay, and ordered by an individual to make payment to another person, just like your check. So it is a written unconditional order to a person requiring them to make a specific payment to another person called the payee. Okay, so what the payment is the bill. The bill of exchange is a negotiable instrument, meaning that it is transferable to a third party. It is transferable to a third party. So you have the importer, we have the exporter, and we have the bank, the acceptance house there as the third party. So you can transfer the bill to them and they help you to pay, okay, with them getting commission if you are the one importing such item. So you can use them, they settle the bill on your behalf and you pay them back but with a commission. And this is how it looks like. This is how it looks like. So you can see two and then for and on behalf of this individual. So this is uh, the acceptance out, the company you're buying it from, the international buyers limited, okay, and then this is the company that the bill is being paid on behalf, and then this is the name of the acceptance house. So it involves three sets of individual, and the maturity days is 60 days. That's about two 2 months. So this is another example of how it looks like. You can see 2 months after they pay Kamal, okay, in order the sum of that for value received. So as I said, it operates between three individuals. And the another tool used is what we call treasure bills. Treasure bills. This treasure bills is an instrument used by the government through the central bank to borrow money in a short-term base from the money market. So the treasury bill are discounted and are made open to commercial banks and other financial institutions for purchase. Their maturity date is less than a year, and at which time the principal and interest are paid to the owner. So this is how it operates. If government need money and they want to borrow internally, it is called internal borrowing. They want to borrow internally. They raise uh, treasure bills, especially if they are experiencing what we call deficit budget. Deficit budget. Deficit budget is when your expenditure is more than your revenue. So government need to they have major expenses, especially when it has to do with capital expenses. Government want to build more roads, they want to build seaports, airports, they need money. So and because of the amount of money they need to borrow. So that will lead to deficit budget, being your expenditure will be more than your income. Income gotten from tax will be less and their expenses will be more. So they want to borrow. They can borrow internally or externally. But with bill of exchange, sorry, with treasure bills, they can borrow internally through the commercial banks. So government sells this bill through the commercial banks to the citizens, and then you go to them and buy with an interest. So they pay you interest on such bills. They pay you interest on such bills. So and it has a maturity days of 90 days, sometimes to less than a year. Now this a good example of the treasure bill is a form of certificate given to you once you borrow government money. So it's a form of borrowing government money and you get back the money. And sometimes government use this bill when there's inflation. So when there's inflation and government want to mop out money from circulation, they sell this bill to you through the commercial banks and get money from your hand. Just reduce the amount of money in your hand and to reduce inflation in the country. And this is how it works. So that's the circle of how it works. So you can see it's a government need 100 naira loan for 180 days. So by investing in T-bill, treasure bills, Mrs. Oti is able to fund this loan at a reduced price of 85 naira. Okay, so loan acquired, government is collecting 85 from you, but it has been discounted, so meaning 15 naira as interest. So great investment for Mrs. OT because it is a safe investment with guaranteed return. It can be used as collateral or can be resold or converted back to cash at any point. So in 18 days, Mrs. OT received full 100 naira loan back, paid back into her account. So it's collecting the money back. Okay, remember, he gave out what? 85 naira. Though government is saying they are collecting 100 naira from you, it has been discounted upfront already. So the interest have been added. So when they are paying back, they pay you back with the investment and the interest together. So it's very safe, very, very safe. Another instrument is the call money. Call money is the money loaned by a bank that must be repaid back on demand. Call money does not have a set date or maturity date or scheduled payment plan. No, it can be called for at any time by the lender if it sees fit. So that's what we call money. The lender can call you at any time that he needs his money and you should be ready to pay. These are the conditions of that, of call money. And that's another meaning to it. So you can either you call it call money or notice money. How it goes to capital markets. Remember I said we have under your financial market, we have two types of markets. We have the money market and we have the financial market. So we'll be looking at the financial markets now. Now, financial markets is a market that give out long-term loans. So lending and borrowing of long-term loans. Remember I said money market gives out short-term loans, but your financial market gives out long-term loans. So it's a market that allows buyers and sellers of loans to interact on a long-term basis. So this fund is created for capital projects. It's created for industries, commerce. Individuals that want to go into business, that want to go into funding of projects for a long-term base. Yes, they can obtain loan from the capital market. So they help to finance existing business and help to expand them. For example, if you are planning to expand your business, you can go to capital market to get such money. A lot of our big businessmen and women or a lot of big organizations are operating under the capital market. So, as I've said, it's a market that allows lenders and borrowers of loans to operate on a long-term basis. So you can get money from that market on a long-term basis. Such money can be used to finance the project and name it. So apart from a commercial bank, all other banks operate under your capital markets. Apart from your commercial banks, okay, be it your mortgage bank, your merchant bank, your development bank, they all operate under the capital market. So we have operators like central bank is there. I've talked about that already. Your development bank is also a very vital operator there. This bank are set up for financing projects in the country. So as I've said, they provide long-term loan for developmental projects. Examples are building of roads, water, electrical infrastructure, including the finance of commercial activities, building of industries, and name them. And we have a lot of them. We have Bank of Industries. I don't know if you have heard of that. Bank of Industry. We have Nigeria Industrial Development Bank. We have Nigerian Bank for Commerce and Industry. We have African Development Bank. That is for African nations. So all these are the banks under your development bank. Okay, so that's your Nigerian Stock Exchange, which is also your operator there under your capital markets. And your this is the apex or the agency that control the commissioner and control the activities in the capital markets. It's called Security and Exchange Commission. Their job is very simple to control the activities of the stock exchange market. So the operators under your capital market, we have we've looked at the first two. We are looking at more. We have apart from central bank and development bank, we have the mortgage bank, we have the insurance companies, and include we have the stock exchange and the Security and Exchange Commission. SEC. All these are operators under the capital market. So when we talk about mortgage bank, we are talking about acceptance of deposit from the public for those who want to buy houses or build houses or purchase houses. So they can go, they can get such services from the mortgage bank. But for those who want to insure their properties, their life, assure their life against risk, okay, insure their business against any form of risk, be it fire, burglary, marine insurance, aviation insurance, you can all get this in this insurance company. So they are also a major operator in the money in the capital market. So instruments used in this market is mainly stock and shares, mainly stock and shares. And at the end, you as a shareholder, you get what we call dividends. You get dividends, as the case may be. So the main instrument is your stock and shares. And what is shares is a portion or share in the ownership of a company. So share represents a claim on the company's asset and earnings. So if you're a shareholder, meaning you're part owner of the organization, a stock is a bundle of shares owned by the number of companies. So that we call stock. It's a bundle of shares. As a shareholder, a person is a part owner of the company and has a claim on the company's profits. So take note of that. And the share you have on the company's profits is what we call dividends. So a shareholder gets a share certificate, which is a documented evidence of his ownership in a company and the amount of shares owned in that company. Now, if you ask your parents, I believe they have shares in a lot of companies. They can even show you their share certificate. They can. So meaning they are part owners of such companies. That will take us to commercial banks. Commercial bank, just going through it quickly. The commercial bank, as I've said, is a bank that gives short-term loans and services to the people. Not only that, you can your assets and your goods can be kept with them. They are there to make profit, and they are also called retail bank. Now, these are some of their functions. They accept deposits, be it you as a firm or as an individual or household. So that's why they have three set of accounts. They have the savings account, we have the current account, and we have the fixed deposit or time deposit account. Not only that, they accept valuables for safekeeping, documents, jewelries, landed property certificates, and then you can all keep them in the bank. They give loans and sometimes salary advancements on a short-term basis to individuals, businesses, and governments. They also act as agent for payment. So I said earlier that you can go to this bank and pay some of your bills. So they are like middlemen, okay, and help to pay some of your bills. So commercial banks provide their customers with current account from which customers can withdraw money for the payment of goods and services and debt settlement. So commercial banks also transfer money on your behalf to their customer through execution of what we call a standing order. So standing order or debit or direct debit. So give a standing order every month, pay my DSTV bill. Every month, send this amount of money to my children as pocket money in school. Is a standing order, and they will help you to carry it out. They'll help you to carry it out. Another function is that the creation of additional money in the system through borrowing of money, they generate more money in the system through interest rates. Okay, so all commercial banks in the banking system as a whole help to create more money in the system by lending out depositors money, and they get interest in return. Not only that, they provide international trade services by discounting as well the bill of exchange on the behalf of the customers who use the proceeds to finance importation. And commercial bank also create a means of ensuring that exporters are paid and the required good delivered to importers through the opening of what we call the letter of credit. So they provide what we call brokerage service between uh, the buyer and the seller of shares. They also are into the foreign exchange market, where remember foreign exchange market is a market where uh, foreign currency are bought and sold. Okay, so if you want dollars, you want any form of foreign currency to trade or to make payment abroad, the commercial banks can provide that for you as well. Part of their function is to issue what we call traveler's check. For those who travel abroad, you might need this check to make payments. Yeah, so they can issue you traveler's check. And most especially, they involved in equipment listing, meaning listing of fixed assets to their customers, allowing repayment period spread over over a year, 2 years, to enable their customers to have access to such items. So you can read more of these from your notes or your textbooks. Commercial banks, sorry, central bank. I've also told you more about central bank. The Apex Bank is called Central Bank of Nigeria, and in some country like America, it's called uh, Federal Revenue Bank. They are the Apex Bank, the Bankers Bank. They supervise the activities of other banks in Nigeria. What are their functions? They issue the country's currency. They are the one licensed and empowered to issue and distribute currency, either notes or coins. So they have the monopoly to do that. So they have been given the authority by the government to issue what we call legal tender. And they are also to control the supply for money in order to prevent in order to prevent inflation. Two, they act as bankers' banks. So your central bank provide banker services to banks. So other banks deposit their money with the central bank. So banks keep deposits and withdraw them from the commercial banks. There's a bank, if there's a bank in need of cash, and their bank have tried to borrow money from other banks, but it could not. You can go to the central bank to get money. So that's why we call them the lender of last resort. Okay? So, and that's why we call them the bankers bank. So banks keep money with them. Not only that, if they need money and they are not able to raise from their banker friends, then they can go to central bank to get such money. Bankers to the government. So government also keep money with them called the federation account. And they also help government to borrow either short-term loans and long-term loans within, which is internal or domestic. And they also help the government to process loans abroad, meaning from other nations of the world, be it World Bank, IMF, Paris Club, London Club. They help them to borrow money, which is what we call the external debt. So it's function of the commercial bank to do such. They help to promote monetary stability by using uh, the monetary policy, which I've explained earlier, interest rates. Okay, so they help to make sure that the price is stable. Because if price is stable, other things will be stable in the economy. So they do that through the open market operation or what we call reserve requirements or discount rates. Okay, so as I said earlier, if there's inflation, government will just increase the interest rate in order to reduce money in circulation. If there's inflation, they sell treasury bills to the people in order to collect the amount of money in their hands. So should mop out money from circulation. They also help to manage our foreign exchange. They help to manage our foreign exchange to make sure uh, that foreign exchange are acquired, allocated, and monitor the use of this currency are monitored because foreign exchange is very scarce. And the amount of foreign exchange you have in your reserve shows how rich you are. So if the foreign exchange is going down, it shows that the country is importing more than exporting, which can lead them in trouble. So their goal is to make sure that our foreign exchange reserve is going higher, is increasing day by day through exporting more and importing less. And if at all we are to import, we should import capital goods. So their job is to make sure that whoever is demanding for this foreign exchange, be it dollars, be it pounds, is using it for the right thing in order not to create a form of problem. Such problem might be increase in demand for foreign exchange, dollars and pounds. And if you are demanding for more of such things, the country's currency will be devaluing, will be going down, which is a problem. So CBN try to guide against that. So they also try to supervise the activities of the financial institution, all the players in the financial institution. There are laws that back up the activities and monitor them, supervise the activities, and make sure that whatever they do promotes monetary policy. I want you to try this assignment. Assignment one, try this, and then assignment two, try it. Try the two assignments I want you to try, and then submit through the normal channel. Thank you, and have a good day.